everyone, and welcome back to the Financial Fox. This is Steffi, and today we are going to talk about crypto and financial institutions. First of all, I would like to thank you, all our viewers, again for sharing the content and for supporting us to grow the channel. This is really appreciated, and please touch the button, subscribe to our channel, and if you like the content, please share it. So our special guest has been already on the show earlier on. She is the Chief Financial Officer of Celsius Network. Her name is Harumi Urata-Thompson, and you probably know already about Celsius, but it is an all-in-one banking and financial services platform for cryptocurrency users. So not only retail investors, but also financial institutions. Earlier on this week, Celsius has announced that it has distributed over $250 million in crypto yields to its user. Those are big numbers. So what we want to understand is what is attracting financial institution to the platform? What is the sentiment? What they are trying to get out, their exposure, but also how the financial institutions are evolving with crypto getting more and more adopted. Let me introduce you to Harumi, and so we can start our conversation. Hi, Harumi, how are you?
I'm doing very well, Steffi. It's great to see you again.
Yes, it's fantastic. I'm really excited because today is going to be a slightly different episode, and we are going to still talk about crypto and DeFi, but we are going to focus about institution.
Yep.
Which, is an interesting space, and it shows also how all the industry of finance is changing, is evolving, is getting curious about Bitcoin and crypto. So I know that at Celsius, you also deal with financial institution. Can you tell me what that side of business and how they interact with the platform?
Yes, absolutely. So as just to kind of go back and then sort of summarize what Celsius does, we do take coins from people like yourselves and myself into the Celsius wallet, and we use them to make money and then pay the rewards on those coins. How we make enough money to pay the kind of rewards that you see on our website or on our app is we turn around and make loans. We make money in terms of interest. We make some investment, and whatever else. Part of that business portfolio is doing the crypto lending with the institutions. So on the other side of retail, also taking the loans out of their own wallet using their own coins as collateral, is we take these coins and do business with the institutions and make additional money. So that's how the institutions really get involved. And there are actually surprisingly many number of institutions that do have a little bit of their portfolio in one way or another in crypto assets, in the form of crypto assets, digital assets. And they often come to lend these assets to us to kind of keep the portfolio balance to where they need it to be.
Okay, but are they borrowing mainly for market making or arbitrage? And also what I wanted to understand is the volume of the trade. And also, are they trading mainly for arbitrage or market making, and what kind of reserves or collateral they have to put? Because, one of the point is if I have to get a loan, I probably have to prove to Celsius and on the platform my history, right? And that is done with my trading that I do there. If an institution come to you, there is already a reputation out there. There is a track record. So are you going to accept less collateral from them in order to borrow from your platform?
Okay, so let's start with the volume. In terms of volume, the individuals, again, like myself, yourself, those of you who are listening, the starting point with us to take loans out of your own wallet is we actually start with $500. So it's but there are no institutions that come and borrow $500 worth coins, whatever the coins that they're looking for. Usual unit goes with $1 million and above for the institutions. So the size itself is already very, very different between the individuals and institutions. Not to say there are some individual investors, individual sort of like in wealth, who come and take significant size loans against their own coins, or institutions that are looking for pretty unique coins and then come in a relatively small size for an institution. But then generally speaking, that's sort of a difference between the size between the retail and the institutions. And in terms of checking the track record, having a history and things like that, obviously all of the customers, regardless if you're individual or an institution, you have to go through your KYC, know your customer process, all of you first. So you already, indeed, if you're already a customer, you already have established a relationship with us by going through the know your KYC process. Now, what's the difference between the retail institutions in this case is that for retail, because the size starts very small and there are thousands of people who are taking loans from within their own wallet, right? I mean, basically every loan is over collateralized, meaning to borrow, let's say $1,000, you might be giving us $4,000 worth coins as a collateral that we lock up within your wallet, right? So indeed, I mean, we don't necessarily have to check all your credit history or anything like that, because if knock on wood, I mean, it never happens, but if something happens with your loan, then we do have collateral that we can take to back it up, right? So that requires actually a lot less work in that sense than the institutions where we might provide some credit line. What we do with institutions, though, because you're right, I mean, they are more reputable. I mean, and there are a lot of like professional fund managers or whoever who are looking after all their money. We actually do a full due diligence on the company. This is after they came through the KYC. My risk officer, financial risk officer, has a phone call, not just one, but several, to get to know them, to get comfortable with them, to go through their financials and getting to know the individuals who work behind all these funds and then everything else that you can think of. This is called risk management. Of the money that we loan out to the customers. And only after he's satisfied and only after they also establish some relationship with us, we may provide some credit line. And obviously the more the reputable, probably, the easier it might be, but we don't just go by the third party reputation. We really actually check institution by institution, especially when the loans are not 100% collateralized.
And listen, your user base is 415,000 users, right?
Users, the customer side, no, we just hit 400,000.
Yeah, exactly.
So yeah.
Out,
I see what you're saying.
yeah,
Okay, yeah.
I wanted to understand, out of your 400,000 users, what's the percentage of institutional investors?
The institution is not even a part of that. So that's a number of people who do the business with us by creating a wallet, the app business people. The institutions, we have give or take, 30, 40 very active institutional customers, plus several hundred institutions that are onboarded. So, we might have each loan size, each business size might be much smaller from the retail side, but the base is much bigger. And we might have much smaller number of customers on the institution side, but each ticket size is much bigger. So the resources allocated actually kind of almost pretty much even out between these two.
And just to understand a little bit better, the reason why institution come to your platform, obviously as an individual, you want to get exposure to crypto, you want to take the risk, you want to put your crypto there and get loan and grow that way. For an institution, which usually their risk profile is much lower, and what is attractive for them about your platform?
But let's start with, so your thing about the retail was also about having an exposure to cryptocurrency too. So let's start with that. Why would anybody actually consider a little bit of an exposure to crypto, whether you are an individual or an institution? mixing a little bit of different characteristic, a different character instrument into the investment vehicle into your portfolio actually does improve the overall performance. Diversification of your portfolio is very, very important. So somebody was actually telling me about the steel and a nickel yesterday, and he was how he was saying to make a really hard steel, all you need is a tiny, tiny bit of nickel that is made, that is mixed into the basic material steel, and then it really changes the characteristic of the steel dramatically, and it makes a really hard, more durable metal that way. The portfolio is really, until he told me about that, I did not think about it in analogy to steel. But really, your financial portfolio is the same. You mix in a little bit of other things, and you all of a sudden have more diversified, more sturdy, more in a way protected portfolio. Now I'm not a financial advisor, so this is not an official financial advice that I'm making. I'm just making a general statement here. But that's how it works. So it is recommendable that anybody who has some kind of portfolio considers diversifying what you have in that group of instruments that you've got. So with that said, a lot of funds and asset managers out there are beginning to consider, at least to consider, if not already putting a little bit of money in cryptocurrency, do have it. I think what's attractive to deal with us is there are a couple of different ways the institutions use us. And one is treasury management. So passively by putting their money through the app business, let's just call it sort of app business, they can already earn rewards on these coins. So it's a very passive way of actually getting very attractive returns. If you look at our reward rates on all of the coins, it's depending on what coins you have, it's still a mid-single digit to mid-teens. The kind of returns that you get depending on the needs and liquidity of each coin that we support. So that is a very sort of efficient way of earning returns on your coins. Plus, if you come to us on the lending business side, then you might put some collateral to borrow cash or cryptocurrencies that they need in order to meet their arbitrage, hedging, all these, or maybe sometimes like going to for short purpose. There are a lot of different ways all these coins can be utilized, and then the coins can be sourced through us by paying some interest on this loan that they take from us. So those are the reasons, some of the big reasons the institutions do have a relationship with us.
Okay, that was a very interesting and also very clear explanation. There is a fund manager, a very well-known fund manager called Ray Dalio, that just came out with some thought about Bitcoin. It was very negative in the past. Now we call it hell of invention, and is actually recognizing the value as alternative assets to gold, basically, like store of value. But obviously he manifest still some concern about regulation and still some concern about volatility and demand. How would you address those points and how would you respond to him?
First of all, store of value is something that I think all of us have been discussing from the beginning. Indeed, does a cryptocurrency such as Bitcoin have store of value or not? When you go and read about the definition of a store of value, I highly recommend it. People actually, classify store of value. Store of value definition itself doesn't change, but what people consider as store of value, the items that have store of value, really kind of varies. Some people only consider cash and some of the established, quotation mark around it, established the financial assets as the store of value. And some people go as far as to say some of the paintings, the vintage wine, and things like that. if the vintage wine that eventually will be opened and then drunk, in my opinion, right? No matter how much you spend for a bottle of wine, in the end, wine's a wine because it's drinkable. So at some point, people would open that bottle and then drink. If that is considered as a store of value, the asset such as, or the instruments such as Bitcoin that you can go out to the market and buy and sell every day, why not, consider it as a store of value? So I'm more of a, yes, I do believe that the cryptocurrency has a store of value. So starting from that, I mean, is it an alternative? I think I already established that point. I do think that it's an alternative way of holding a little bit of a part of your portfolio than just holding equity or just holding a bond. And I do think that it changes the profile of the return of your portfolio. And indeed, yes, they are somewhat all correlated at the end of the day. When one market is doing well, I think we have a tendency in the market out there, although like we used to say bond and an equity always move to opposite directions, it's not necessarily the case. So, I mean, do they have some kind of correlation in between all these different financial instruments? If you run the analysis, we can probably find some kind of relationship, some more correlated than some others. And, in such environment, I think it's a wise decision to put your money into a variety of instruments, including something like Bitcoin, to make sure that you have that variety in your money portfolio.
I mean, we see what Elon Musk did, obviously, adding Bitcoin to Tesla balance sheet. What do you think has changed in the institution sentiment and the percentage of their portfolio they are keen to invest in an asset such as Bitcoin? I mean, you are interviewing those institutions, so you will know how the sentiment has changed and how much they are keen to put into crypto.
So I don't think it's a secret that especially these established, very old financial institutions like bank were very, very negative when the cryptocurrency first kind of came into the scene and began to put some splash out there. I don't think, I mean, it's only a few years ago when the CEO of JP Morgan Chase came out with a statement and said, anybody of my staff who trades Bitcoin is fired, right? So it's only like 3-4 years removed since then, and all these banks do have some kind of, at least are looking into, if not already building, some kind of minimum blockchain infrastructure. Some of them might even have a digital payment aspect built into it. So I think the overall sentiment is definitely changing. And I mean, we all know that some of the money transmitting system that we have in the system is a very old, cranky one, and some of the new or blockchain solutions may or may not. We don't know where this is going to go, but may replace that, and it might actually, improve the process. The initial credit card business itself, I mean, it's probably really with us for any country that you can use it. It's been only maybe last 20 years or so, 20 maybe 30 years or so. But the idea of this plastic payment has existed much, much, much longer than that. And then this is a point that I always bring up. What we call emerging technology today, whether we are talking about internet, artificial intelligence, space technology, all these things existed since 60s. But it's not only until, say, right around 2000, the millennial kind of time frame, that all these things really kind of became a major thing in the scene and making a big splash out there. So it does take time for all these different technologies to grow up, fully mature, and then be utilized by everybody in the economy and become a real sort of a critical mass, sort of mass adoption takes place. I think cryptocurrency, blockchain, all these things are the same. I mean, this is one of the newest, youngest technology that we've got. And then I think we have to be a little bit more patient before say, oh, this is not going to go anywhere. This is going to be held by only like really sort of minuscule amount of people in the world. I think we are a little bit, and we are not giving it enough opportunity to fully grow and everybody come up with enough use cases to make sure that it's implemented into every area where we can.
And what do you see being, let's say, looking ahead 10 years, do you see the financial institution being replaced by, a new system, or how would you see an integration of both?
Like I said, I think a lot of institutions, not just financial institutions, but institutions are already looking at the blockchain technology itself in one way or another. Maybe they haven't implemented it yet. Maybe some of the institutions haven't even really kind of physically started it yet. But a lot of institutions, both governmental and for-profit organizations, are looking into it, building it. Some of them might be even already leveraging it. And I think this is only we are going to see this more, even more 10 years from now. So is it going to override every other system that we have in the economy? I don't think that's going to happen in 10 years. But is it that more people are going to be looking at this, more people are going to be using this, more institutions will have adopted by then? I would say absolutely yes.
And how that is going to reflect in power and sovereignty from
It's
an
a good
institution
question.
perspective.
It's a good question. I think there always will be some kind of centralized authority in everything, whether we're talking about money or business management or data management or anything like that. I think there always will be a centralized authority looking after certain things. Even when even on the financial side, we talk about DeFi, the decentralized finance. There's always a management team that is running that kind of decentralized financial scene. But can we distribute the governance power a little bit more? Absolutely possible, and I don't see why it wouldn't happen.
Okay, that's really interesting. The last question. Let's come back to Celsius. So, what I wanted to understand is, at the moment you have some very attractive, juicy rates that they are making the platform, as I said, really attractive to any kind of investor. Is there any additional product that you offer only to institution and you are not offering to retails?
Um, Technically speaking, the retail can only take cash or cash equivalent loans out today, and institutions are taking both fiat, stable coins, and other cryptocurrencies as part of loan. So that I think you can already say it's a different product within sort of like a larger concept of loan. Will there be additional products just for the institutions? Pretty much we are always going to be retail first kind of company, so any additional products that we are going to be thinking about, I think it's always going to have minimum, it's going to have retail in mind as we develop, if not only retail in mind. So will there be institution only? Time will tell. I mean, we are growing up really, really fast, and both retail base and institutional base is growing fast. So, well, will there be a case where we might come up with something that is more fitting for the institutions? It's always possible. But I also will say we are always community-based company, and the retail, the individual customers are always going to be the center and front and center of our business. So that's always going to be the core of our business.
Okay, very, very good. Final question. I would like to pick up your brain on synthetic assets. And, we discussed the institution, they want more and more exposure to crypto, but some, they would rather maybe look at a synthetic assets rather than cryptocurrency. How do you think the market is evolving?
Well, when you say synthetics, if we're talking about things like derivatives or that kind of nature, I mean, I think it's already utilized. And I think it's only going to be utilized more. So what I think of it, it's it's whenever you put money into something other than your own sort of hard-earned, in my case, dollars, right? It's there's always that minimum foreign exchange risk, whether that foreign exchange is we are talking about the traditional sense of foreign exchange or cryptocurrency, the dollar to cryptocurrency, or maybe like you put the money into equity and then equity goes up and down, uh, or the bonds that you are holding might get called earlier than you thought it was going to be. All these risks exist out there. It's real. So when you are, and especially as an institution, when you have millions and millions of dollars of exposure, you start using some of the derivatives instruments out there to support some of the downside risk. It's really a thing. It's a real thing that you need to worry about. It's a real risk management that you need to work on, and for that, leveraging things like derivatives and other synthetic products is more than reasonable. I would say it should be a part of your risk assessment and portfolio management that you need to be always thinking about.
Okay. And listen, price of cryptocurrency, where we are now, do you think, they are going to kind of stabilize? We reached the top with Bitcoin and now, it's kind of like settling, or you think we are going to see some kind of decline and, um, it was a little bit too much of a hype, let's call it that way, or you think it wasn't?
So it came up very, very fast, which means when you study the chart of any of these cryptocurrency assets, there's no meaningful support as the market goes down to a certain level. So it is possible that on the way down, uh, a lot of people will be taking some profit to lock that in, or there might be even a little bit of a sort of a liquidation position that would show up somewhere in there. That said, I'm going to go to my very first point, which is that it's still very, very, very small portion of the population, global population, that is putting money into cryptocurrency. And I do think that a little bit of a correction is actually always a healthy thing. Anything that is only going to one direction, whether we're talking about financial assets or anything, if it's only going to one direction, it's actually not healthy for the market. It's actually good to see market that goes up and down and up and down. An ideal situation is it goes up and down, and then it kind of takes a gradual rise in the price, right? I mean, in case of Bitcoin and stuff, it just went up like this. So I think, like I was saying at the beginning, it might take a little bit of a correction at this time. But I think because there are only so many people who are in this market so far, correction should be seen more of a entry opportunity for a lot of people who have been thinking about it for a while, missed opportunity because it went up too fast, to kind of jump in and grab the Bitcoin while it's priced at the, relatively speaking, reasonable level. So do I think that there is more upside? There will be upside. It's not gonna, the last high that we have seen is not gonna be the high ever. But are we gonna do a little bit of a correction? I think it is doing that right now. And it is, am I seeing it as good or bad? I'm actually seeing it as a good thing for the market.
Okay. I think we all agree with you. And listen, on the last note, for new institution they don't know about Celsius, they want to know a little bit more. Where can they find you?
Oh yes, so we do have the website, which is an obvious place to find us, which we are revamping right now as we speak. And also the first touch point for a lot of people will be our phone app. It's a very easy one to download, and I think process to get KYC is very, I think, pretty straightforward. So those two are the obvious sort of places where you can go to learn a little bit more about us. We are also very active on social media like Twitter, LinkedIn. So that's where you can find us, where you can also find me too.
Exactly. Arumi, thank you so much for being on the show today. It was a very, very interesting chat, and I hope to have you back soon.
Thank you, Stephanie. Yeah, let's do number 3 sometime in the near future.
Exactly.
All right, excellent. Thank you.
Thank you. Okay, this is everything from the Financial Fox, and I really hope that you enjoy our episode. And please subscribe to our channel, share the content, and I will see you next time.